Well, good evening and thank you for joining us on the Building Africa Infrastructure Dialogue. I'm Onyi Sunday. Now, the cost of addressing Africa's infrastructure deficit is approximately $90 billion every year for the next decade. With over $100 billion committed to large-scale infrastructure, West Africa has the greatest value of projects underway on the continent. But despite ongoing investments in the region, a number of projects in West Africa remain suspended owing to the downturn in commodity prices. Now, in the wake of this challenge, how will West Africa bridge its infrastructure gap? To discuss the state of infrastructure in West Africa, I'm joined here in our Lagos studio by Olusola Lawson, Regional Director, AIIM. I also have Opuiyo Oforiokuma, Managing Director, Arm Harith Infrastructure Investment, and Rochelle Moore, Head Infrastructure Finance at RMB Nigeria, joins us from our studio in South Africa. Thank you so much for joining us, lady and gentlemen. Now, when we're talking about infrastructure in West Africa, I'd like us first of all to start off with Africa as a whole. Let's really get a very clear picture of what the continent really lacks. We're talking about Africa needing between 93 billion to about 100 billion to bridge infrastructure deficit for the next 10 years. So let me start off with you, Shola. What do you make of this whole narrative about the huge deficit in Africa's infrastructure? We hear this year in, year out. What do you make of what's been happening?
Look, I think the story hasn't changed, and it's been the same for the last 10 to 15 years. There is a massive infrastructure deficit, and depending on who you speak to and which day of the week it is, numbers vary from 50 billion to the 122 billion, as you said. What has been encouraging for me is that in the last 10 years, you've seen much greater private sector participation. I think the rate of private sector participation in infrastructure has doubled every 5 years over the last 12 years. The other thing was that since 1999, more than 50%, I understand, of IPPs have been funded using some private sector capital in the mix. So the deficit is large. There's a number of steps that need to be taken to attract private sector players, but we are moving some way in that direction, which is encouraging.
Well, Rochelle, let me come to you now. When we talk about, of course, these huge infrastructure deficits on the African continent, what do you think suffers the most? Are we talking power, road infrastructure here, or are we talking ICT or even water? Because that's also very important. Which do you think is the biggest victim here?
Certainly all of the above. I think they're all suffering from a very weak framework. Legal framework, regulatory framework. Obviously, you have some that are more important than other in terms of the impact on the economy generally. So you've seen a lot of effort spent and a lot of talk around the power sector. But transportation, ICT are equally important, including water. So the latter, for example, is very difficult because obviously having a price that will still allow the low population to have access to this absolute necessity makes it even more difficult to have a economic and financial value proposition when you structure them, but they are equally important. But we've seen a lot of push on the power sector and on the transportation sector over the past years.
Opuiyo, do you agree? What's your take on this?
Well, I certainly agree with both what I've heard from Shola and Rochelle. In fact, just picking up on where Shola started, what I'd say is of that 90 billion to 120 billion that's required, when you dissect it, probably about half of that number requires entirely new financing. And we mustn't forget that, albeit not in the best state, there is some infrastructure. And so roughly half of that number can probably go to rehabilitating existing infrastructure. And then through better maintenance, we can actually extend asset lives and get some utility there. In terms of what Rochelle said, I absolutely agree. The reality is that power, ICT, transportation, water, etc., are all essentials. But the one thing I would say that we must be very careful not to do is to treat Africa as one homogeneous mass, because it's not. We must remember that there are several countries in Africa. We must also remember that we need to look at each one in context of its own localized priorities and then deal with that. But one statistic that continues to alarm me is that in Africa, look at the power sector, for example, about 600 million Africans do not have access to reliable utility scale power supply. They are depending on things like burning firewood and raw charcoal to get power. They're depending on generator sets, all of which are very environmentally damaging. So something needs to be done, and done pretty quickly.
Now, Shola, he just talked about the fact that, yes, we must look at Africa is a continent, and there are countries in Africa with their own peculiar problems. But then we have problems that recur in every country here in Africa. Like he just said, power is one of them. And then we also have road infrastructure. Let's not even talk about road infrastructure in terms of helping to facilitate regional integration or regional trade. Let's talk about it country by country to begin with. But taking a look at road infrastructure, where do we stand at the moment, or rather transport infrastructure? Where do you think the continent really remains at the moment? Earlier on today, I was talking about facilitating regional trade or regional integration through ports on the African continent, and we also really haven't gone far when it comes to that area as well. But just talk us through, how far we have come when we talk about transport infrastructure on the continent.
Look, I mean, the reality is that within the transport sector, you've got a number of subsectors. So you've got ports, you've got airports, you've got roads. In terms of roads, I think outside of South Africa, there are very few countries which have launched more than one successful PPP initiatives. If I take South Africa for a start, we were involved in financing 3 of the early toll roads, which date back to 1999, and which we've since exited. So there was a long culture of toll roads with private sector participation. It's not always the case for other countries in Africa. I mean, in Nigeria, clearly there was the Lekki toll road, which Opuiyo was the MD for a long time. We were also involved. And that is one example of a successful road project in this country. In Ivory Coast, you've got the Konambede Bridge, which is another example of a successful road project being developed. In Senegal, you've got the Eiffage project there, which is also a toll project which has been implemented using private sector capital. So there are examples. Kenya has a quite big roads project on at the moment. There's the Kampala Ginger Road, which is about to be privatized between Uganda and Kenya. So there are one-off examples in the road sector of projects which have either been successfully executed or are in the works. I think outside of roads, the port sector has been much more successful in attracting private sector capital. You look at the 2 ports here in Nigeria with the APMT port in Apapa and the one in Onyi, both have private sector capital. There are 2 other additional ports which will have private sector capital involved. And if you go down West Africa, actually through Ghana, through Lomé, through Abidjan, even in Gabon, all those ports have a private sector player in them. So ports have probably been towards the most successful end of the transport spectrum in terms of being able to attract private sector players.
Now, Opuiyo, just going by what he's just said, and talking about advances that have been made in transport infrastructure with a focus on roads now. I mean, statistics here show us that only 1/3 of Africans living in rural areas are within 2 kilometers of all-season roads. So it just begs the question that most of the funds we actually get, for infrastructure development in Africa, where does it really go to? Because if we're talking about a continent that hopes to turn around its narrative, say, of course, through agriculture, which really is top on the list for most governments across Africa, the roads are really very important. And then if we have the statistics, it really just says a lot that not much has been done, or most of the road infrastructures haven't been put up in areas where it's needed the most. Do you think the concentration is more in the urban areas than the rural areas? Well, what are we seeing?
Yeah, I think that's probably true, Onyi. I mean, but the reality of the matter is, it's just 2 points to mention. The first one is that we're seeing more and more urbanization across Africa. A lot of people are leaving the rural areas and they're all piling up into the cities. As a consequence, a lot of infrastructure expenditure has been focused on the cities. But as you rightfully say, when you begin to look at diversification of economies more towards the agrarian sector than, say, commodities like oil and gas, then there's a critical need to ensure connectivity between the rural areas and the urban areas, both from the point of view of moving people, as well as it is for moving goods. You know, about 50–60% of agricultural produce, gets wasted through perishing because when they're harvested at the farms, there's very, very poor road systems or maybe rail systems or air systems, as the case may be, to evacuate that produce from the farms all the way to the market, including for export. So something obviously has to change there. And, policy setting is very important in this regard. Your comment about where does all this money go? I mean, a lot of the money today, back to the broader infrastructure story, is finding its way into power. There's nothing wrong with that per se, because we do need power. But if we're serious about actually making agriculture succeed, then we need to have a rebalancing and policy setting, incentives and other frameworks that are designed to promote, if you like, that more even spread of infrastructure is important. Final point I just want to make here is this, that it's not every road project or infrastructure project on its own that's economically viable. So you're not going to expect private investors to go chasing after projects because it is maybe politically or socially desirable if they can't see how they're going to make their return. That's again where policy setting and other things like subsidies maybe or other incentives may be useful in channeling investment down that track.
Interesting. Well, Rochelle, what's your take on this? Now, how important do you think, of course, policy setting is in ensuring that the right investment or money is channeled into the right projects? He just talked about the fact that, of course, investors are looking at viable projects. There's also this talk about ensuring that African governments, present viable projects to investors as well when it comes to them investing in infrastructure. Taking a look, of course, at the same thing we're talking about transport infrastructure. What's your take really on what the government should place as a priority, especially when attracting investors, and also bearing in mind that you also need to embark on projects that will affect the lives of the people? I'm saying to myself, a good road leading into into a rural community, of course, open doors for business opportunities to begin with. You never know what a community has to offer. Until you actually, show them that they have a walkway into the cities as well for whatever it is they produce, no matter how little it is. But what do you think comes first? What should be the priority really with setting up a business plan or a project plan for infrastructure to attract investment?
So I actually couldn't agree more with what Opuiyo said. I think the regulatory framework and the legal framework is definitely key. There's a reason why it's called PPP. There's a important leg of that collaboration between the private sector and the government that needs to take place, and there needs to be coordination in ensuring that those projects are viable and sustainable. Attracting private sector, funding, you obviously need to have a value proposition, for investors to get an appropriate return. And the reality is, especially when you look at transportation and roads, you can't really, foresee how successful those, can be, because you can't force someone to use a certain road, and in often case, you need to have a proposition for an alternative road, for the population. So you would obviously, forecast a certain level of revenue depending on the traffic that you're projecting. But if there is a shortfall, then there needs to be answer as to who's going to be able to bear, that shortfall and literally fund it in order to ensure that the investors, who are taking a long-term view and investing for, 10, 15 years, will still have return on investment. So when you take that into account, venturing into the rural area do have a value proposition, but once again, you would have to look at the numbers and and see how they translate in terms of return. And as we progress, I think the need with your urbanization is definitely more in the cities. But as we progress and have a framework, a systematic framework for vetting and implementing those projects alongside with the various government entities, then we can have a more efficient and cost efficient as well, because it takes time to develop those projects. And the more uncertainty or changes you bring into that process, the costly it is, for the project and all the investors. So as we systematically have processes with the government that can be implemented quicker, faster, more efficiently, we will be able to reduce the cost and also venture into areas that may not be so attractive today, but as the cost of the project reduce, would still be profitable for the private sector to come in.
I think it's quite interesting in terms of the question of why has more private capital got into power as opposed to some parts of the transport value chain. And I think if you look at roads, for example, and you compare what a typical road is from a business model to a power plant, you will find that there's some elements which potentially make it less bankable in terms of volume risk. You're taking traffic risk on a greenfield road. And one thing you know about forecasting traffic is that you always get it wrong, either up or down. And you're also taking, to some extent, currency risk in a way that you wouldn't necessarily in many power plants on the continent. So, for example, you would be able to link certain aspects of your power charge to a hard currency if you're a hard currency funder, in a way that you probably can't do to the same extent with the road. So I think those two elements have historically made financing roads a little bit more difficult than financing power plants. And even within the transport sector, ports and airports have historically had some hard currency elements to them just because of the nature of their operations and the fact that a lot of the users of those infrastructure assets are global or international players. So there's an important distinction to be made.
Yeah, interesting, Shola. But the thing is, that I'm going to tell you why I really asked that question. I've happened to cover most rural communities or states here in Nigeria when it comes to, of course, infrastructure projects. And then you step into some communities, of course, where maybe some power plant is really close by, and they're still without electricity for weeks to begin with. And then you find out that these are really, agrarian communities. These people stand by the roadside, just, waiting for people to come help. But this is, okay, so we had like a before and after project, and before then, you had most of the agricultural produce perish. This is what they survive on, and a lot of money that's potential in that state. The government actually realized this much later on, that the moment a road went through that community, it was easy. Like, the next time we visited there, we had to ask if we're in the same community, because then you had lots of cars, you had lots of trucks coming to take out agricultural produce into the urban city that really do buy that agricultural produce really very expensive because they had, they lacked access to it in the first place. So I really ask myself sometimes, really what comes first? I mean, you have this power project here, it's got its own challenges, either maybe owing to a lack of gas supply coming in there, vandalism is another problem to begin with, and the fact that some of them don't even have meters to begin with for you to want to read. So I say to myself, what really determines what really determines what investors put their money in, when you're presenting some of these business models? I just want to be able to understand how it works. I'm not very clear on that. Opuiyo, do you mind explaining?
Yeah, sure. I think the first word I would use is opportunity. So where are the opportunities? The other one is preference. I mean, Shola is actually quite right. When you look at different types of projects, first and foremost, not every investor can do power. Not every investor has the experience or capability to do roads, water, ICT, etc. So there is the preference, which obviously suits your skill set. You're also going to look at the regulatory framework, you're going to look at the risks and so on and so forth. But I think the equation needs to be balanced, not just from the point of view of the investor, but you also need to look at the point of view of the end user. Pointless giving people a road if they think their priority is power. So one of the first things that needs to be done is a needs assessment. So as I said before, we're not looking at a homogeneous continent, even homogeneous countries within that. Each one has its own priority. So I think that's the way I'd look at it. And most importantly, I'll then begin to look at the dynamics on a road. Shola mentioned things like the traffic volumes, who carries the risk. Is there sufficient traffic to actually finance, if so to speak, the amount of capital expenditure you're going to incur on a particular road? And even that capital expenditure is going to vary by where exactly, what are the topographical and other conditions, what kind of technology, etc. are you using, what's the scale of the road system, what incentives are there, security and other things to protect. But if you look at also on the power side, which is quite interesting as well, I hold a view that also requires a difference in approach. At the moment, a lot of the times we've been looking at these big super grids. The truth of the matter is that across the African continent, in many of the countries, it'll take too much money to expand the grids to an extent where it covers the entire country. A place like Nigeria, for example, I think is very poignant given our scale. But however, we begin to change our mindset away from the national grid to then be looking at mini and microgrids, you can actually get power to targeted, localized areas a lot faster. And of course, over time, there is the scope to consolidate that onto much larger platforms, as the case may be. So I think there needs to be a complete sea change in approach. I also believe that trying always to eat the elephant whole, leads to choking. So if you do it, smaller bits, you can most likely get the solution a lot faster and where you want to get it to as well.
Well, interesting. Well, Rochelle, we'll just talk about, of course, major sectors where we really require infrastructure funding or assistance. We talk about, of course, power, transport infrastructure as well. Taking a look at the continent, do you think there are areas that still suffer, the areas that you wish that investors really look into? They may not be economically viable, as that's actually the selling point at the moment, but are still, help is really needed, development is really needed in that space. What comes to mind for you when you think about such sectors? What sector comes to mind?
I actually think that you listed them both, and those are the ones we've been talking about. I think the power sector is definitely key to any country's economy, and some studies shows that once you have access to electricity, you are able to reduce the cost of doing business by 30-40%. So it has and also increase the GDP by a significant percentage. So it definitely has a key impact on the country and on other sectors. The other one is transportation, and for the reason that you mentioned, it is critical for trade, for business, for quality of life, that we do invest more in those areas. The issue, and obviously once again, so the impediment for those sectors to grow as fast as the needs require them is, once again, for me, is the uncertainty. So to your previous question, when you were asking about the rural area, I actually don't think that there's limit in funds and that we have to choose. We could do both power sector, both transportation and other sector simultaneously if we had certainty around the framework, and also if we had the collaboration that I was mentioning earlier with the government in terms of how do we approach this project, implement them, and take them to complete to completion. So we need to continue in doing that. There's lots of sources of funding that is available. Obviously, there are challenges, as we can see, for example, in Nigeria at the moment with the FX, but we need to keep pushing those kind of projects and ensure that they get done. The private sector is has shown that they're definitely interested, taking more and more risk, because the risk allocation is also shifting. Taking more risk. To invest into those projects, we just need to have certainty around the framework and the regulatory and policies around those sectors.
Well, it's really interesting listening to everyone talk about it from the business perspective, because let's face it, if the investors don't see what they're going to be getting, the return for the money given, they see no reason going into it. But at the same time, also looking at it from, I wouldn't call it the human side, but really these are indices by which the continent is being judged by. I mean, taking a look at the statistics says only 6 million hectares, concentrated in a handful of countries are even equipped for irrigation. Water security in Africa remains a problem. And these are kind of some of the real issues I really want us to take a look at. I understand, yes, where the investors are coming from. And that's why I said, do you think there's a sector that requires attention but isn't getting much of it at the moment? Those things, at the end of the day, turn around to affect businesses one way or the other. And Shola, that was where I was really coming from by asking, that question. What do you think? Do you think infrastructure projects essential to humanity are overlooked by this quest for returns on investment on the African continent?
Overlooked by who?
By investors.
By governments
and investors.
Look,
the government's going to get money. I mean, the government's actually looking for partners to come in, and the partners are saying, what am I going to get back in return? So, of course, they're going to be pushing forward projects with returns.
I think it's a fair question, which leads to the next point. There are various sources of capital. The one end, you have capital that the government provides, and it's the government's job to provide basic infrastructure, to provide amenities for the people that live within a country. At the other end, you have people who invest for a living, and their mandate is to get a return on their capital. Now, in the middle, you have various other degrees of capital. You've got donor capital, which is more to the development and humanitarian side, and then you have further down the spectrum, development capital from development institutions around the world, which try to marry both the social objective with a return element to that as well. So there's a whole spectrum of capital that can be tapped into to fund these projects. I mean, if we're being very honest, you mentioned a number of 100 billion. There isn't enough capital in Africa to fund the infrastructure deficit. So there has to be a level of selectivity around the projects which are prepared and which are put forward. And those that are harder to finance privately should be financed by the government, which should be financing the lion's share of any infrastructure within its region. And the more attractive economic projects should be financed by greedy guys like myself. I know.
No, speak for yourself. In fact, I would put a slightly alternate view.
Okay.
And what I want to say here, because I'm sure you'll be going to a break anytime soon, but what I want to say here is that I don't think there's necessarily a conflict between investing for return and also providing utility to the end user. In fact, the secret to getting returns is that you're providing your infrastructure at affordable cost, consistently, reliably, in a way that people are prepared to pay for, or there's some kind of subvention or otherwise to make it bankable. So you can't divorce providing end user utility from making your returns. The two go hand in hand.
I think the point I was trying to make was that you need to have both.
Yes,
to make
absolutely.
a project work. An investor wouldn't go ahead with a project which delivered a negative return, even though it delivered positive externalities to an environment.
Interesting. We're going to be talking more about this after the break. And I think it's time with a focus, on West Africa and how we're doing in that space. The topic of discussion is on infrastructure development in West Africa. We've been taking a look at Africa as a whole. A focus on West Africa will be coming up after the break. I've been speaking to Olusola Lawson, Regional Director, AIIM, Opuiyo Oforiokuma, Managing Director, Arm Harith Infrastructure Investment, and Rochelle Moore, Head Infrastructure Finance at RMB Nigeria. Stay with us. Welcome back. If you're just joining us, we're discussing West Africa's infrastructure development challenges and the way forward. My guests remain Olusola Lawson, Regional Director, AIIM, Opuiyo Oforiokuma, Managing Director, Arm Harith Infrastructure Investment, and Rochelle Moore, Head Infrastructure Finance at RMB Nigeria. Thank you so much for staying with us. Well, Rochelle, I'm going to start off with you. Now the focus is on West Africa. Now with about $20 billion committed to large-scale infrastructure projects in West Africa. The region has the greatest value of projects underway on the continent. Just bring us up to speed on how this region is taking advantage of what's at its disposal at the moment.
So we see a lot of initiative, and indeed, I think the policies and the government officials in certain countries in West Africa have been putting in place policies that are, fueling growth and restoring investor confidence. So they've seen over the past, a few years, a flow of funds, coming into the country to support infrastructure projects. So we see, and everybody nowadays is taking the example of Côte d'Ivoire, for example. You have Senegal, so they are in multiple cycles already of producing PPP project, should it be in the power sector or in the transportation sector, and they are receiving a lot of attention, a lot of interest, from the private sector. So it speaks once again to the importance of the environment, creating an enabling environment where, investors, those projects require a long-term view of the country, of its institutions, of its policies, are able to see through and are taking comfort that the rule of the game and the rule of the law is not going to change because you have institutions that are, strengthened, and also, policies that are, consistent despite, changing governments or other factor that may affect the macroeconomic environment. So you also see the same in certain places in East Africa. Obviously, South Africa is the country that has benefited the most from those, and we hope to see that replicated across sub-Saharan Africa, given the need that there is. And I just want to say that in my view, it is my personal view that there is sufficient funding available. I think the reason why funding is not coming through is because the project, or at least the structure and the risk allocation of the project being put forward, are not necessarily appealing, and that the private sector is subjected to take more risk than it is willing to to take. Investors are comfortable taking commercial and financial risk, but not so much macroeconomic or political risk. So once we, those areas which the government can address are sort of dealt with, by the government, we would see, investors being less eager to participate into PPP projects. So it is critical. It is critical. The role of the government is critical in instilling confidence, in those sectors for attracting private sector investment.
Opuiyo, what are your thoughts?
I agree wholeheartedly with what Rochelle is saying, especially about risk. You see, look, if you simplify investment, it comes down to two things, risk and return. And the return needs to be commensurate with the level of risk that you take. But one of the most important things in terms of risk is risk allocation, between, the parties. So in a PPP, the allocation of risk between the public sector and the private sector. And getting to understand what the private sector is willing to take and can take, for me, is a very, very critical point. I think for this, we need government to be better informed, maybe have better advice to ensure that they're not just taking things for granted and assuming that private sector investors will just be happy to take whatever comes. The other thing as well is that I would advise that government are very careful when they make comparisons across the board. Oh, we saw that happen in that country, yes, but examine comparatively what your environment is like compared to theirs, how easy it is to access raw materials, labor and other inputs, even hard currency, which has become a major issue in countries like Nigeria. Again, the issue about priorities and so on and so forth. So I think that risk-return trade-off and allocating risk is a very, very important one. One other thing I would add as well is behaviors in terms of government, because I personally believe that in projects that are PPP-type projects, behavior by both parties is important. It's one thing writing things down on paper, contracts and otherwise, but those contracts are only so good as the actual implementation of the same. So things like respecting the sanctity of contract is important. Giving confidence to investors that, look, what we say as a government is what we're going to do over the long term and consistently so. All of these things are extremely, extremely important. Setting policies, take for example in Nigeria, one of our several challenges today is about currency. How reliable is it that if I bring my money into this country as, say, a foreign investor, that I'll be able to get the money out when the time comes? How can I be assured that the currency is actually adequately priced and that there isn't some hidden hand maybe playing political tunes around? I'm not saying that's the case, but I'm just saying these are questions that investors will inevitably always look at. How willing are people to pay a toll tariff on a road? How willing are they to pay the electricity tariff or the water tariff, and so on and so forth? So I think until those things are dealt with in a way that it's more than words, people can physically see this happening consistently over the long term, it's very difficult to attract and sustain investment. But what is good, as Shola had mentioned before, we're seeing a lot of investments already coming into West Africa, including some queuing up to come as there's greater policy clarity. Why I'm saying that is because where you have at least one model starting, it sets a precedent that other people can actually emulate or better still improve upon. So the climate is there, the opportunity is there, the need is there, but there's still a disconnect in terms of policy matching, trying to attract people in. And we still have one or two issues in terms of the behaviors of the parties on the public side to ensure that there is comfort on the private investor side.
Shall I hear contributions?
Sure. Look, I think West Africa, developments in West Africa are interesting because you have different things going on within the different countries in the region, which are quite different. So if I take the petrol economies, as I say, and include Nigeria in that, Ghana to some extent. Does Gabon form part of West Africa? If it did, I'd put it into that pool, which are going through currency issues now because their economies are to some degree linked to a single or multiple commodities. And then you have the group of countries which are linked to the euro through the currency, the CFA, and have been enjoying extraordinarily low monetary interest rates because their monetary policy is controlled by the European Central Bank, and that includes Senegal, Cote d'Ivoire, Benin, Mali, all these CFA countries, which are beginning to look very attractive because some of those countries are growing at GDP rates of 5 to 8%. If I take a country like Mali, for example, which is what I'd call an emerging West Central African country, growing at 5-6% a year. The environment is actually becoming quite interesting from an investor's perspective because you have currency stability, because you have GDP growth in the mid-teens, and that's exactly the same in Cote d'Ivoire. It's similar in Benin. It's similar in Togo. So some of these markets which were potentially less favored, largely due to size, are becoming a lot more interesting for investors now. I'll just touch on currency again because I think it's so critical from two perspectives. The first perspective is as an international investor, if what you're trying to attract is FDI, there needs to be a number of elements which give investors confidence to convert capital from one currency to a local currency. First is that you need to have some comfort around convertibility. I should be able to, if I brought in capital, get my capital out. And that's a policy controlled issue. There's two other issues which are, the second is liquidity. Can I get the dollars in the system to meet obligations, pay my financing, which potentially can be dollar financing? And the third issue is around the volatility of the currency and the impact on return, which is more of an economic consideration rather than a policy consideration. But those three considerations are key for an offshore funder. But there's another aspect of currency which is quite interesting, which is how do we encourage long-term, permanent, local currency financing into infrastructure? When I talk about local currency financing, I'm talking about real money accounts, insurance companies, pension funds, I'm talking about capital markets, long-term bonds. that element has always been a key feature of infrastructure funding in most countries around the world, which is how a lot of emerging markets have managed to de-link returns on infrastructure projects from what's happening to the currency, because they're being funded locally. So you go to Mexico, you go to India, a lot of the power purchase agreements are 100% denominated in local currency. And that's because you can fund those projects with local currency. So until we develop that aspect of the funding schematic, we're still going to have these issues with
Let's bring in Rochelle here. Rochelle, what do you make of what Shola has just said, now talking about, of course, local funding?
Yes, it's absolutely correct. It's a major issue, and it's a finance 101 major rule where you have to match your asset and liability in the same currency. And we haven't been able to see that a lot, particularly in the Anglophone countries, where a lot of the cost is still, a lot of the financing is still raised in US dollar, for a good reason. I guess the equipment is being bought in US dollars. However, there is definitely a need to explore, local funding, and some of the issues have been the cost historically, and second, the tenor. Obviously, infrastructure finance require long-term tenors, 10 and above, to make the project, viable. Because from a tariff perspective as well, you can't, have a short tenor. So we need to, tap into, there's tons of available funding through the PFAs and insurance, like Shola mentioned, that we're not tapping into. And we understand that those institutions do have appetite for those kind of assets. It sort of match their, cash flow profile. Obviously, there's a risk issue associated with it. Once again, the risk allocation in the project should be very well understood and well structured, and also a regulatory, issue that should be looked into. But it's definitely a good source of funding for the financing gap we've been talking about, and hopefully we are able to find solutions, including also in the capital market.
Interesting. Well, Opuiyo, I was really going to ask what you make of the spread of infrastructure investment on the African continent. We see that for the funds coming to the continent, Nigeria has the largest share, with about 38 projects, followed by Ghana with 16, and then Senegal with 14. Now, the only major one with Guinea, which actually accounts for 16.7% of the total value of projects in Africa, well, that deal was also cancelled in July. I think that's the Simandu iron ore project that was cancelled. I guess the investor said they couldn't justify developing the mine owing to the current overcapacity in the global iron.
I think it was sold. It was sold from Rio to a Chinese group, and I'm not sure if it's been cancelled. Yeah,
it's actually halted. That's the news we have earlier in the month. I was going to ask that, but I see that talking about alternative, financial solutions to investment, to infrastructure, is really very key. Listening to Shola and also listening to Rochelle. She's mentioned a couple of areas, of course, a couple of ways that governments across Africa can source for funding for infrastructure projects. But what comes to mind, for you, that those who actually posit for sourcing through Africa's FX reserve invested abroad, of course, pension funds as well, sovereign wealth funds, public-private partnership, that's like the buzzword we keep hearing every now and again. But, for you, where do you think the solution lies at the moment? Where do you think Africa can own its own projects, cater for it long-term as well?
I think it's a mixture of all of the above. And we've talked a lot about public-private partnerships, so maybe I shouldn't dwell too much on that, but let's recognize that a subset of public-private partnerships is actually how you source for the capital with which to finance them. Shola had raised insurance funds and pension funds. Look, pension funds globally are probably one of the largest institutional capital providers for infrastructure anywhere. Probably about a third of all capital comes from pension funds. And they are a very good source of long-term capital, which are very well suited for infrastructure projects, which also have a very long-term horizon. This is very important because the commercial banks are restricted, like things like Basel III, having to match assets and liabilities, and because of a lot of their assets or liabilities are very short-term, they can't take the exposure that we require for infrastructure projects. So, as Rochelle had mentioned, tenor is very important. The cost of debt as well is also very, very important. And I can tell you, in Nigeria, for example, there are new products that are coming on stream, maybe infrastructure debt funds, monoline insurers that will hopefully help make it easier to match that type of pension capital, maybe insurance fund capital to infrastructure projects. In terms of sovereign wealth funds, I think to be very meaningful, they need to be of the right size. And certainly in Nigeria, our sovereign wealth fund, about 1.5 billion, maybe going towards 1.8, is fairly small. And there's only so much you can do with that. So I think we need to also develop a culture of national savings. And that way you can build up the pool. I mean, you see even in countries like Botswana, where they have a $9 billion, circa $9 billion sovereign wealth funds. And of course, you go to the Middle East, and these things are huge. They run into tens of billions of dollars. So, you know, this is something that we should learn from, that unless you actually provide that capital, it's hard to always attract foreign investors. When you do bring up foreign investors, they will always be thinking about how they can get their money out home. And that currency situation will then come back again because they want to repatriate in a currency that, if you like, matches their home base. The issue about local currency funding is so critical. Again, I fully agree with Shola that when you bring in, you know, pension funds and other local capital, that takes the issue away. Now, Rochelle makes a valuable point about imported equipment driving a lot of this, but I think that you can also structure transactions such a way that you can hedge, you know, against the cost of what you bring in. But ultimately, the key thing to remember is this: whilst you can assure yourself you're going to incur costs, you have to ensure that the revenue stream is affordable. So to the extent that you lock your price in one time, you buy your assets, and then you start recouping and servicing your debt. Your debt is usually 70% or thereabouts, if not more, of your total cost, which cost includes the cost of the equipment. So really being able to de-risk that debt side from currency volatility, I think is a very, very important thing. And the sooner we can actually begin to develop that sort of financing stream, the better. But one thing I will finally have to say is this, that whatever we do, we need to ensure that we create the environment where equity will be willing to take risk. So even though equity is typically a smaller percentage of the entire financing cake, the truth is it's the equity that takes the risk, and having good equity players therefore attracts the debt. The equity will then deliver that project on your behalf. So we've got to also find ways that we can channel capital, whether it's pension funds or otherwise, into that equity side. One statistic that I bandy around a lot is that the infrastructure needs, certainly in West Africa and maybe Africa as a whole, is probably about 90-95% greenfield, because there's barely anything really out there. So again, if you're going to tackle greenfield, you need to deal with the equity problem before you can truly attract the debt in to make these projects actually financeable.
Interesting. But Rochelle, let me bring you in here. We're still talking, of course, about financing infrastructure projects on the continent. And when we talk about local financing here, governments are still pushing for foreign direct investment in infrastructure on the African continent. Now, do you think governments across Africa employ good and clear cost-benefit analysis on most of their projects in order to attract partnership from the private sector, be it within or outside West Africa? What countries do you think in West Africa, you know, are actually applying very good models that are worth emulating? What have you seen so far?
It's probably always the same names. So, you know, you definitely had some success. If I start with the Francophone countries, you had some success in terms of the government, you know, being able to attract funding for those kind of projects. In, you know, we've seen that in even in smaller countries like, you know, Cameroon. We've seen that in Côte d'Ivoire, which we've mentioned a lot, and we start to see it literally, you know, across the Francophone countries. You had some success, you know, in Ghana and relatively in Nigeria, even though you know, currently with the various challenges, you've seen, you know, a reduction in FDIs, you know, being able to come in. Obviously, South Africa has had, you know, tremendous success But generally, you sort of have a cycle where it starts, but there's no continuity, and sometimes you are, taking back. But some countries are being consistent, in developing those kind of projects, but they're very few.
Interesting. Well, Shola, what do you make of this? What countries have you seen so far in West Africa that have got the right models? Because I'm taking a look at Nigeria, that's actually got the largest share. Do you think we've got the largest share because we've got the right business model here?
The largest share
of actually investment and investments of projects that are actually ongoing as well. Look, I mean, Nigeria's about $72 billion.
I think we've. I'm not sure whether those numbers are based on projects which are in construction or pre-construction projects. Look, I think Nigeria has done a reasonable job. We set up the ICRC to be the sort of figurehead for coordinating the government's PPP framework and legislation. We have, in the space of 3 years, privatized a value chain of 19 different power assets, probably as quickly as anywhere else in the world. So, let's not beat ourselves up too hard. We've done some things right, and there are other things which we need to get right. And I think, look, that those things will come. In other markets, I think if you want to have a look at markets which are functioning well, we have to go back to a place like Cote d'Ivoire, where in the power sector at least, the structure of the way the contracts are structured have led to a situation where the off-taker is bankable and has been for a number of years, been paying the invoices that they've been sent. That still needs to flow through to a number of countries. But I'm going to take a country out of the Western region to give an example of a procurement program which has been wildly successful, and that's in South Africa. So the REIPP, Renewable Energy Investment Program, which I think we're now on to the 5th round of procuring a number of projects, has raised something in the region of $14 to $16 billion for renewable energy projects in a very short period of time. And there are a lot of lessons from that which other countries could apply if they want to get a similar procurement process right. One of the key things was not trying to enforce a market price ab initio. It was letting the market settle at a rate where it was comfortable because a number of projects had been executed successfully beforehand. So it was an auction, but without a reserve price. People bid the tariffs, and a number of projects were selected. And what you saw was between the 1st and the 5th round, tariffs coming down. Solar tariffs initially starting at the equivalent of 28 cents per kilowatt hour. Today, 7.5, 8 cents, 9 cents, that sort of region. And that has been a gradual reduction because people have got comfortable in the environment. In other scenarios, you have a tariff imposed by the authority on a market, which is going to prove much more difficult because it's not market tested. You need to let the market find its level. So I think there are lessons to be learned from that process, which could be applied in other countries.
No, I'm very happy that Shola brought that up. I'm talking about renewable energy projects, with this quest for energy on the continent. Here in Africa, how much are we hearing of investments in that space? When we talk about renewable energy, or we about exploring the natural resource we have at the moment and leaving that aside? Where do we stand on this?
It's happening. If I start with, Shola's already given the example of the South African renewable energy program, which is fairly successful. We heard earlier in the year about solar in Zambia, where the tariffs are actually even lower than there's South Africa, about 6 cents, I think it was. Here in Nigeria, there are currently 13 power developers that signed PPAs with NBET, the bulk energy trader, and have since submitted bid securities to support that. You might argue if the tariff was imposed, that's about 11.5 cents. There's a process leading to close of those transactions somewhere in Q2, Q3 of next year. We're seeing, for example, I know of a project in Ghana which involves biofuels. If you look at in Benin Republic, next door to Nigeria, where they have an extremely high coverage, they are very much focused on solar power as well, and so on and so forth. But one of the important things I think about renewable energy is probably twofold. Is clearly there's the environmental considerations, especially post COP21 in Paris of last year, and a lot of DFI and multilateral money is pushing the market towards the renewable side. Here in Nigeria, for example, a very large country, very diverse, you might actually find that in terms of an energy mix, we can sustain, the good old traditional thermal type of energy with renewables like solar, biofuels, hydro, and so on and so forth. Let me use an example. Most of our power plants are fired by gas, which, as we know, is found mostly in the southern region. To then try and transport that gas all the way to the north, can be quite expensive because you're looking at building rather lengthy pipelines. But in the north of Nigeria, where you have very high irradiation levels, that could be very, very suited to solar power. And there you can certainly get a better balance and get development out and so on and so forth.
We're going to have to actually end on that note there. It's getting more interesting now because I really like to hear more about the renewable energy. I really thought I had more time on my hands, but it's really been interesting talking to you gentlemen on this issue today, and Rochelle as well. Well, that said, on Building Africa Infrastructure Dialogue here on CNBC Africa, many thanks to my guests, Olusola Lawson, Regional Director, AIIM, Opuiyo Oforiokuma, Managing Director, Arm Harith Infrastructure Investment, and Rochelle Moore, Head Infrastructure Finance at RMB, who joined us from our South Africa studio. I'm Onyi Sunday. Thank you so much for watching.